Good morning, everyone, and welcome to class. Today, we are looking at investing in mutual funds, bonds, Sukuk, and other fixed income instruments. So I can use the word instrument, I can use the word asset, and I can also use the word securities. So those are the three ways that people would normally qualify investment. So if you're investing into some investment, we can say they are fixed income assets or fixed income securities or fixed income instrument. We are talking about the same thing. So generally, the world economy runs on debt. So the good thing with this particular module is it's a bridge between economics and finance. So I'm going to be talking a lot around economics. For some of you who have, whether you are economics major or minor, or you did a major of economics in school, you will be able to relate with most of the things that I will share. But in my usual manner, I'll try to simplify it as much as possible. The world economy runs on debt. Debt is a foundational element of the modern global economy. It fuels growth, enables investment, and allows both government and corporations to manage cash flow and fund large projects. Rather than being a sign of financial distress, debt, when managed responsibly, is a strategic tool for economic development. So, what is the brief, or what is the meaning of all those things that I've just read in simple English? Government everywhere borrow money. Borrowing money is an integral part of the world economic system. So when you hear things like Nigeria is owing so much and Ghana is owing so much, US is owing so much, it's not a big deal. That's the way the economy is designed. The economy runs on debt. You have to borrow to do key projects. Matter of fact, government borrow to pay debt. Let me give you an example. So I'm going to talk about Treasury Bill and all of those instruments that they use to borrow money in the course of this model. When a loan is about to fall due, government can borrow money to pay the outstanding loan. If you do that in personal finance, it's not a good way to handle your finance, meaning that you have a loan of 1 million naira that is going to be due, say, in next month, and you don't have any income in view that you would use to make that repayment. You can now borrow 1.2 million, maybe borrow another 1 million at X% to pay this other outstanding liability. Government do that everywhere. Corporations do that everywhere. But when you are doing that from a personal finance point of view, it is not an effective way to manage your finance. You get into trouble. So you need to keep that at the back of your mind. And when you think about it, the total money in the world right now, there is more, there is more virtual money, as it were, than paper money. So let's assume that the total money in circulation today, someone should actually Google that. What is the total? Google that and put it on the chat box. Let me get you guys involved in this. Google it. What is the total money in circulation in the world economy? So let's assume what you see is 50 trillion dollars. I'm not sure. Let's assume that is what you've seen as the total money in circulation. Of those 50 trillion dollars, maybe about 40 trillion dollars would be virtual money or digital money. And I'm going to explain that in a bit. Then maybe $10 trillion will now be the actual paper money in terms of dollars, pounds, pence, cents, naira, cedis, rands, rupee, and all of those things, right? Actual paper money may be like $10 trillion. And we tend to use dollars when you're talking about global currency, because dollar is the adopted currency globally for global transactions. Yeah, dollar is one that is most recognized for global transactions. So when two countries are trading, they tend to use dollars, apart from the BRICS country. So some countries have started breaking away to say that this dollar thing is holding us back because that puts US in a very powerful position to dictate what happens to the global economy if they are the ones who own the currency with which the world trades. So some countries have said, we don't want to follow this pattern. We don't want to be subservient to the US economy. We don't want them to dictate what happens in our country. As we're in Nigeria right now, everything that happens in Nigeria is being decided by the US, by the US. Why? Because of the dollars, right? Because a lot of our transactions happen in dollar, whether import, export, everything is in dollar. And because our major raw material or revenue, our major revenue head in Nigeria is crude oil, right? Is priced in dollars. So when we sell crude oil to the international market, what we get back is dollars, right? So some of those countries have now said that they don't want to continue doing this US dollar thing. So they they are gradually coming out to form their own unified currency. And those countries are called the BRICS country, BRICS. B for Brazil, R for Russia, I for India, C for China, and S for South Africa. So Nigeria also has more like an affiliation with these guys. We don't belong to them fully. We're not full-time members, but we have some sort of affiliations with them. So within these countries, when they trade, they can use their own currency. Even though Nigeria also has some form of agreement with China that for the purpose of trade between our countries, we can use our local currencies. So if Nigerians are buying things from China, right, or from Chinese companies, they can pay in naira. And if Chinese companies are buying things from Nigeria, they can pay in Chinese currency, which is, I think, is I've forgotten the Chinese currency. I think it's not rupee.
Yuan,
Yuan, sorry, thank you. And they can pay in Chinese currency. So how do you think all these transactions are done? Most of them, it is done through the central bank. The central bank midwives that process. So meaning that as a Nigerian company, if I want to buy something from a Chinese company and I'm supposed to pay in naira, so how do the Chinese company really receive that money? Because truthfully, they probably won't receive naira because naira is not usable in their own economy. So there is still a backdoor arrangement or a backdoor intervention that the CBN does to, produce the yuan that is needed for that transaction and all of that. I just needed to explain that to let you guys know that how the economy really works in terms of physical currencies and virtual currencies. And another topic that would come under this is the fact that banks are very critical to the development of any economy, right? Banks have the capacity, I don't want to call it legal right. It is actually legal within the context of the financial laws. Banks can create money. So let me give you the example I like to use in my class. Let's assume that you go to the bank today as a bank customer. You have an account with Zenith Bank or Access, any of the Nigerian banks. You walk into the bank that you want a loan of 100 million naira. They do your credit checks. Part of their own risk management procedures is to check your credit history, check your transaction history, check that you are reliable, you are all those 4 C's of lending. You have collateral, you have capacity to repay, you have their 4 C's of lending. Someone can also Google what those 4 C's are, right? So once they check all those boxes and they want to give you the money, where do you think the bank actually gets the money from at that instant to give you the money? So what they do in practice is to create 100 million that doesn't exist before. So for every accounting transaction in account, the basic rule of accounting is for every debit entry, there must be a corresponding credit entry. In accounts, we post all transactions twice. To help you understand this, if you go to the if you want to give me money and you want to give me 100K, that transaction is going to happen in two ways, or it's going to have two legs. If you send me 100K from your account right now, we'll post it in two ways. We will debit you because you are the one that has sent out the money, and credit me. So that's why we say in account, for every debit entry, there must be a corresponding credit entry. If we just debit you and there is no show of where the money has gone to, that's fraud. You will go to the bank and scream the roof down, because why did they debit you? And it's not like you have given an instruction for the money. Where is the money? So they must be able to show you where the credit entry has gone to. Take that same understanding into you now going to the bank to get a loan. When a bank credits you 100 million that you want to borrow from them, where do you think they debited to give you that 100 million? Obviously not, they cannot debit another customer's account to give you 100 million. Or they will just let me just talk like an amateur. Or they will just gather money from different customers' account and then debit, they want to get 100 million. They will now start debiting 5,000 from different customers' accounts so they can give you the 100 million. No, that's not the way it works. All those customers will show up in the bank and it will be chaos. So what the bank does is to temporarily open an account. It is a backdoor account. You don't have access to it. They debit that account with 100 million so they can credit you with 100 million. What they have done at that instant is to create 100 million that doesn't exist up until that time. Banks are allowed to create virtual money that way. But the big but is, because if you say that, if banks are allowed to create money, it means they can just be creating loans like that. No, there is also a limit to it. Currently in Nigeria, I think you cannot do more than 10% of your trading capital. So if your trading capital is 500 billion, it means the highest amount that you're allowed to create is 50 billion. So there are regulations around that. But again, banks can create money based on this principle that we are discussing of how the economy works and how money works. So let's go on to the next slide. The next thing you need to understand is capital market. What is a capital market? A capital market is like any other market. The only difference is that when you go to this market, you don't buy momo and meat or pepper from this market. It's a market where financial transactions happen. And the market is in two layers. We have primary market and secondary market. Primary market is a place for the producers, the source, the people that are originating that security. While secondary market is the market for resale. To help you understand, let me give you another relatable example. If you want to buy 100 crates of Coca-Cola for your wedding, you are unlikely to go and buy it from Nigerian Bottling Company in Edo or their factory in Ikeja. They won't sell, they are likely not to sell to you. Why? They will tell you that is why we have distributors. Go and buy from distributors or wholesalers. People that can buy from them directly are the distributors. So that kind of buying can qualify as the primary market, where you buy directly from the source of that product. The secondary market is a market for resale. So now they've turned you down, and the instruction is go and buy from wholesalers or distributors. What they are doing is they are sending you to the secondary market. Where do the people in secondary market get the products to sell? They've bought it from the primary market and they bring it to sell at the secondary market. So that's the way primary market and secondary market works. In the same way, instruments are sold at the primary market. Instruments like Treasury Bill, um, stocks, and all of those things, they are sold at the primary market. People can buy it. Institutions can buy it and come and retail it at the secondary market. We'll get into the details of that in subsequent slides. So how governments borrow through capital market. So governments issue bonds, Sukuk, Treasury bill to raise funds for infrastructure, social programs, budget deficit. These bonds are sold to investors in the capital market. Yeah. So these are government borrow money. They give you a promissory note, just like saying that government comes to you right now and say, Abdullah, please borrow me 50 million. This is a promise note that I will pay back with 15% interest on so date. Most of those investments are promissory notes. It's just a note of promise to say that at so date, I will pay you back so amount. So there are different types of them. There is bond, there is treasury bill, there is sukuk for those that are for those that would like. Someone asked in the last class that she would like a non-interest investment because of your faith. The faith of a Muslim, a practicing Muslim, prohibits interest. It's called riba in Islam. Prohibits the collection or the taking of riba. So you want non-interest investment. Sukuk would be the best choice for you in this category, and I will explain how it works. So if there is no interest from Sukuk, how do they now make money? What is now the incentive for wanting to borrow for? So the word is lend. What's now the incentive for wanting to lend government money if you're not going to get anything back, right? It's not that you're not going to get anything back. It's just that it is not an interest arrangement. It's more of a profit arrangement. So in Sukuk, this is how it works. You give government money. Let's say you have 10 million to invest. You invest it with government. Government take that money. If it is, say they want to use it to construct road that will have toll. Some of you that live in Lagos, Lekki Ikoyi Express has a toll gate. Lekki Expressway has a toll gate. So if they are going to construct a road that has toll like that, they collect money from investment, and if they are going to fund that kind of road with Sukuk, so they construct that road, they erect that toll gate there, and they start collecting toll from there. Whatever toll they collect, a share of profit will come to you as the investor into that Sukuk. So that's how Sukuk makes money. To help you understand it better, I'll use another example. So let's assume that you go to an Islamic bank to borrow money for your business. I think Islamic banking is one of the best things that happen to Nigeria, just like people are not taking advantage of it. I don't have to be a Muslim to take funds from Islamic bank. The most important thing is your business must meet their requirement. They don't invest in all kinds of businesses. So your business must meet specific requirements. So let's assume your business meets the requirement and they give you the loan. They've done all their risk management. Their risk management process is very tight. Let's say they've done it and you've passed. They give you the loan is interest-free loan. So if you want to collect, say 10 million, they give you the 10 million interest-free. Do you know the catch? The catch for me is not even that the loan is interest-free. The catch for me is that if anything goes wrong with that business, you won't pay the loan back. What are those things that can go wrong? Someone took a loan to stock his or her shop, right? And when you stock the shop, like all these fire incident that happened in this Lagos market, in these last couple of days, there have been like three fire incidents, one at Mandilas, one at Afriland Towers, and maybe one from somewhere else. So people lost properties. Sellers lost their products. So I've just taken a 10 million naira loan from an Islamic bank, and I just lost 100% of my products in a fire incident. I just need to present the evidence to the Islamic bank, and it is both our losses. So in Islamic banking, your loss is my loss. That's the process or the threshold on which that arrangement stands. So your loss is my loss, or the premise, your loss is my loss, your profit is my profit. If I make profit from that business, there is an arrangement that will now split the profit in certain percentages, but you are sure that they will only come for you if the business has done well. You will only be repaying when the business has done well. It's different from conventional banks. If you take a loan from Access Bank today, God forbid, something now goes wrong, like your fire incident now happened, God now help you. You also don't have insurance to insure the shop. You have lost on two fronts. The first front is you have to look for money to fix your shop back if you're ever going to come back into business. Second layer, the bank money plus the interest that they charge you, you must pay, right? So the best they will do for you is they will give you moratorium. Moratorium in banking is grace period. They can say, let's give you 6 months to catch your breath. But after 6 months, you must pay us back our money. It's other people's money. I won't go and tell Sheyi that I lent his money, even though technically, don't forget, the bank created they created that loan, but it's still part of their capital and all of those things. So let's move on. That's how governments raise money. And I said, where do they get the money to repay? Repay when you subscribe to bonds and government pays you interest. Where do they get the money to do all of that? It is from taxes, from they can also do refinancing. I mentioned refinancing earlier, meaning that the loan is running out, they don't have money yet, they can take another loan to pay that one, and then it just keeps going like that. Example, the US Treasury or Nigerian government issues bonds regularly to finance federal spending, with buyers ranging from domestic investors to foreign investors or foreign governments. So let's now move into the core of the matter, fixed and variable income securities. As the name implies, fixed income are those kind of investment that gives you a regular, predictable return over a certain period. Variable are the ones that are not predictable. It's just predictability is the differentiating factor between fixed and variable income investment. If you're investing into a fixed income investment, you already have an idea of what you're expecting to get. But variable income is the forces of demand and supply that dictate what you get from it. Example of variable income would be when you invest into stocks, right? You don't know whether the stocks, even though you've done your analysis based on what we shared last week, but you're not still 100% certain that your analysis will be correct. And so a lot of things is hinged on hope and speculation. But in fixed income investment, you can categorically say that this is what I'm putting, this is what I'm getting. Yeah, predictability is the word. And I share some examples of fixed and some examples of variable income investment. For fixed income, we have bonds, mutual funds. Even though mutual funds is a bridge, there are some mutual funds that are fixed, there are some that are variable, and we'll get into mutual funds so that you can understand what I'm talking about. Then we have fixed deposits. Under variable, we have instruments like shares, ETFs, and REITs. Let's look at mutual funds. What is mutual fund? The word mutual. It is a pool. Mutual means another word for mutual in this context is collective or cooperative. Several people coming together to create a pool of funds. When they pool the money together, you can now invest the money into different asset classes. So what they invest into is called underlying assets. It is that underlying asset that helps you determine whether this investment is low risk or medium risk. What they are investing that mutual funds into. So when you see a typical mutual funds fact sheets is like the document that accompanies the advert. They will tell you what that mutual funds is invested into. They may tell you that it invests into 70% equities. If they say it invests into 70% equity, it means that's medium risk investment. So if you put 1 million in that investment, 70% of it will be invested into shares. And you know how the shares market, you know how the shares, the stock market operate, very subject to volatility, it goes up and down, up and down. We discussed that extensively in the last class. So some can invest into ETFs, some can invest into commodities. Next week, I think that the class of next week is focused on commodities, right? And alternative investment. Very exciting class as well. Then you can invest into bonds, you can invest into treasury, you can invest into money market and all of those things. So these are the types of mutual funds that we have. Again, types tells you, I told you that what gives you the insight into whether a mutual fund is low risk or medium risk is the underlying assets. So these are some of the underlying assets or some of the things that mutual funds invest into and the types of mutual fund. We have equity fund. Equity fund invests into stock. We have fixed income funds that invest into bonds and other government securities. Someone that is following, apart from bonds, mention two other government securities. I want to see whether you guys are following. I've mentioned it earlier, but I just want to test you. Thank you. Franca, thank you for the collateral the 4 C's of lending that you just posted. Yeah. Mention two other. I've seen one. Kachi, I've seen it. Apart from Treasury Bill, I mentioned another one. Mention it.
Commercial paper.
No, commercial paper is not
promissory note.
Government security. I said all these things are literally promissory notes. Yeah. Okay. Eurobond is actually a government security, but that's what I was looking for. Inform, thank you. I mentioned Sukuk earlier. Yeah. So I said the ones that I mentioned earlier. But someone said Eurobond. Eurobond technically can also be a government security. It depends on who is issuing it because there are corporate Eurobond as well. And we'll get into that. Yeah. Then we have
debenture.
Excellent. Debenture as well. It's also a government security. So then we have money market funds that invest into short-term debt. Then we have balanced or hybrid fund that invest into both stocks and bonds. Of course, then we have index fund. Index fund is more like is an ETF, but it track a specific market index. That index fund can be a bit confusing, right? Example of index funds is S&P 500. S&P 500 invests into 500 companies in the world. It's a global ETF or a global index fund that invests into the top 500 companies of the world. So what is index in that instance? So what the index does is, the index is like a programming language, if I can use that word. It tracks the performance of those 500 stocks. If at any point in time, they've already set a threshold. Let's say the threshold is, say, if any stocks goes below 20%, knock it out of the top 500 and look for another company that meets that requirement and quickly fit in that company. So that at every point in time, that thing is adjusting, taking out companies, replacing companies. So that activity, as it were, is what we refer to as index. Yeah. So let's move on to what are the benefits of mutual funds, diversification. Because don't forget, your money is not invested into one thing, is spread into different asset classes based on the underlying assets that they've told you about. Then experts make the decision. So you give your money to a fund manager. The fund manager takes the decision on your behalf of where to invest the money to and where not to invest it to. Funds cater to different risk levels and financial goals. Yeah. So for those that are low risk, the appetite is still very low, right? You can just stick with fixed income funds that invest, the ones that invest into fixed income. And you know that my 15% is my 15%. I don't want more. I don't want less. But let's quickly move on to, because I still want to talk about each of them. So bond. Bond is the way government raise money from members of the public. Nigerian government currently issues bonds every month. So you will see the opening, the advert every month is always between the first 10 days of the month. It can be first to seventh or second to ninth, but it's usually in the first 10 days of the month. They will issue the advert. You can subscribe. They can say 1 year bond, 2 years bond, 3 years bond. They can say 3 years bond at 17% per annum. What does that mean? So if an investor invests 10 million at 17% per annum, it means that person will get 1.7 million every year for 3 years. But the interest on bond or the coupon is called coupon. In bonds, in investment generally, there are some language that is specific to different investments. So, I said in Sukuk, we don't use the word interest because it's Islamic compliance. So we use the word profit, share of profit in Sukuk. In bond, we don't use the word interest. We use the word coupon. So if the coupon on a bond is 17% per annum and you have invested 10 million, you are going to get 1.7 million every year for the 3 years. Year one, 1.7 million. Year two, 1.7 million. Year three, 1.7 million. At the end of year three, they return your principal of 10 million to you. It's borrow now. You didn't dash them. You borrowed them. So they will refund it at the end of the investment, but they will have paid you the interest during those years, right? And that interest of 1.7 million does not also come once in a year. They break it down into quarters. So there are 4 quarters in a year. January to March, quarter one. April to June, quarter two. So at the end of March, you get the first tranche. So they divide that 1.7 million divided by 4. Whatever that is what you get every quarter till the end of that investment. But what you are going to get, by the time you sum up everything, to be 1.7 million times 3. At the end, they refund your principal to you. So that's the way bond works. Then these are the types of bonds, just to give you some theoretical knowledge as well. Because when they say bond, it doesn't mean it's just government that uses bond. Corporates also use bonds, and that one is called corporate bonds. It is issued by companies. Companies issue bonds rather than seek bank loans for debt financing. In many cases, because bond markets offer more favorable terms and lower interest. So if Access Bank needs 500 million, they can choose to raise that 500 million from the capital market. But that kind of bond will be called corporate bond. The one that is issued by the government is called government bond, government savings bond. Then state government can also issue bonds as well. Then the last type of bond is euro bond. I mentioned last week that euro bond, even though we call it euro bond, it is not denominated in euro because euro is not a global currency. It is denominated in dollars. So currently in Nigeria, for you to invest into euro bond at the primary market, meaning directly with the government, which is the issuer, or directly with the government doesn't mean you go and meet the government. Directly with the government, there is an intermediary of government that does this investment. It is the CBN. For you to do it with the CBN directly, you need a minimum of $200,000. So not a lot of people can afford that. Because of that, people tend to now go to the secondary market where you can start with as low as $1,000. So some people have bought the $200. Some people can afford this $200,000. How can they afford it? Through mutual funds. Don't forget I said mutual fund invest into some things. There are some mutual funds that specifically invest into Eurobond. For instance, now if you invest into dollar mutual fund, where do you think they would invest your dollar mutual fund into to make money so that they can now give you some money? It is into an instrument like Eurobond. So when they invest into Eurobond, because an institutional investor that has collected money from different people would now have liquidity to afford $200,000 investment compared to when one person wants to do it. So that's how Eurobond works. Then I also try to show you the differences between bills and bonds. Bills are treasury bills. Yeah, then bonds are like corporate bond, government bond. The major difference within the context of Nigeria is the duration of it. A bill is usually for limited period of time, less than 1 year. A bond is more than 1 year. A bond can be from 1 to 10 years. But anything that is less than 1 year is bills. Bills in Nigeria is Treasury bills, or we also call it T-bills. They are short-term government instrument that is issued by the CBN on behalf of the government. The repayment is always less than 1 year. It can be up to 364 days. One day, once it is 365 days, it can never be T-bill again. It's now a bond. So how does bond works? How does T-bills work? I've told you how bond works. The most interesting thing with T-bills is that it pays you the interest in advance. And the example I always like to give here is when I wanted to buy a car for my wife, I think now last year, the cost of the car was 10 million naira. It was a Tokumbo car that I wanted to buy 10 million. So what an average person would do is to just go into his or her account and withdraw the 10 million and pay for that expenses. I don't do that. What I look for is what investment can give me the interest to pay these expenses. So, of course, I had the principal. So I looked for a T-bill and I put my capital in that T-bill. That T-bill then paid me 17%. So, and the interest is paid in advance. So let's say I drop 100 million in that treasury bill today. They will pay me 17 million as my interest that same day and retain my principal. Then at the end of that investment, they return my principal to me. So that's the way treasury bill work. It is one of the investments. In fact, I think it's the main investment, only investment right now that pays you your interest at the beginning of that investment. So you can now use your interest for something else. If I don't need that money at that instant, as I take that interest, I invest it into another vehicle that can now generate another interest. So my interest is still generating interest while my capital is working. So a lot of wealth creation is a function of your mindset, how you think about money, how you think about. So you must think about money and things, not the way regular people think about it. That's what I'm trying to say with this. So look at the example. CBN sells T-bills. Of course, CBN would not give you T-bills at 100,000. For you to invest in T-bills in Nigeria directly with the CBN, you need a minimum of 50 million. And it happens every 2 weeks in an auction. How does it work? Let me give you the practicality of it. You have to open. I sent a memo, more like a memo that I wrote to previous cohorts on how to open your account. Some of the people you can reach out to open some of these accounts for you. And it is unlimited to those people. I only gave you those ones because those are the ones I use and those are the ones I have a relationship with. We have over 100 dealers in Nigeria. Just go to NGX website. You will find them. You can reach out to them. It's not compulsory. You have to use those guys. So it happens in an auction. So you open an account with them. I have an account with Cardinal and Cordros. Every 2 weeks, they send me an email when that it is open. The auction is open for like 3 days. They send me an email. They send me CBN is trying to raise money in this cycle of treasury bill auction. Please send in your bid. It's a bulk email that they send to their customers. Let's say they send it to 20 of us, and 20 of us have the money to invest. We now want to send in our bid. On your bid document, Abdullah can say that, let's assume all of us, I'm going to pick some of your names. I'm going to use just 5 people. 5 of us have 50 million each to invest in that treasury bill. At that time, Abdullah is number one. Abdullah now says that for this 50 million, no, Abdullah will be a Muslim. He won't like interest. Let me go to Ayo. Ayo now says that for this 50 million, I want you guys to give me 10% interest. So what is 10% interest of 50 million? 5 million. Bernice says that for this 50 million, I want something better. I want 20%. So I want 10 million interest. But they says that for this 50 million, I want 7% interest. Everybody just, so what you're doing in that process is you are bidding. So you all send in your document. Of course, you won't see what each other, you won't see what Bayero won't see what, or Bernice won't see what Ayo is writing because we're all in different places. So we all send in our bids. CBN will now sit down. They have representatives that will now sit down and look at it. They will choose the one that they feel favors them more. So in this case, in these three examples that I've given, if you were CBN, which one would you choose as the successful bid? You can only choose one. What are you going to choose? Put the answer.
The one with the least percentage.
Of course, the one with the least percentage. So that's what most people. So you choose the one with the least percentage, and that becomes a successful person. So let's assume the one with the least is the 5% guy. So the 5% guy, when the 5% guy wants to make that payment, how does it really work? You put, let's say you have to put an account that has 50 million in that flow. You put your account. There will already be a debit instruction. They can debit that account directly. Facts, matter of fact, right now, CBN can debit anybody's account directly if they want to, right? But they won't do it until there is a cost to do it. CBN can also lien anybody's account. They can also, because we now have BVN, there's a BVN system. So when people say things like Nigeria doesn't have data, it's a lie. Nigeria has data. Maybe the actual what we don't have is harmonization of those data. And a lot of times there's also reluctance to release the data. A lot of agencies have different data of different kind of data. So if you want to do like an intervention program that you want it to reach the poor and vulnerable Nigerians, people that really don't have money, CBN can easily give you that data. They have it of poor and vulnerable Nigeria. Some of the metrics they will use is uh, the banked customers. They will have more of the banked customers, the people that have bank accounts using their BVN. They can see someone that has not done more than 1 million naira transaction in the last 5 years. Is there in the account. They can see through there because except most of the transactions you are doing is just cash transaction and you are not really using the bank at all, which is more difficult right now because of cashless policy. I don't even know the last time I really held cash in my pocket to pay for anything, right? Even if you go to traditional market right now, normal open market, you want to buy tomatoes, you see that those guys now have POS, you can transfer to them with OPay and money points and all of those things. So those things are really fast changing and we must not just stay stuck in the past and just assume that Nigeria is still like it was 50 years ago, especially where data is concerned. Research institutions have a lot of data. As well, there are some people that's the work that they do daily to go and collect this data. The harmonization, yes, there is still a challenge with that. So they choose the one with the least amount. You put 50 million in your account. If what they've agreed is the 45 million, they will now take 45 million from it. You have your 5 million as your interest. That's how your interest is paid in advance. Then when they are done, they pay you back your 50 million. So that's the way Treasury bill works. The interest is paid in advance. But if you don't have 50 million, does that mean you cannot invest in Treasury bill? Of course you can. Those means that you can invest in Treasury bill at the secondary market. People that have invested at the primary market sometimes can retail their securities on the floor of the stock exchange. Okay, I need to run now. I'm almost done. The next one is commercial paper. So we started with bonds. Oh, no, I technically we started with Sukuk. We went to bonds. I talked about Treasury bill, and now commercial paper. Commercial paper functions more like Treasury bill. But the main difference is that commercial paper is used by private companies, both listed and unlisted private companies. If they want to raise money to cover time-sensitive liabilities. Don't forget, just like I said, Treasury bill is for short-term, time-sensitive liabilities that government wants to quickly raise money. Same way, commercial paper is for short-term, time-sensitive liability. They want to quickly raise money, but right now it's not government. It is the private company or the listed company. What do I mean by listed company? Companies that have PLC. in their names. Dangote PLC, First Bank PLC, and all of those PLCs, flour mills, and the rest of them. They can quickly also raise commercial paper to use commercial paper to raise funds on the floor. In exchange for this funding, they give interest to investors. Okay, the next one is certificate of deposit, which is also like fixed deposit, right? Is a savings product that earns interest on lump sum for a fixed period. Just understand this as fixed deposit, because in Nigeria,